Hello, everyone, and welcome back to another episode of Financial Market Insights for Traders. I'm your host, Sophia, and today we're going deep into the bond market. Specifically, we're talking about yield curve strategies, the key differences between municipal bonds and U.S. Treasuries, and how bond ETFs and ladder strategies can help you build reliable income. Now, I know bonds might not sound as exciting as trading tech stocks or crypto, but here's the truth. Bonds are the backbone of long-term wealth building. They provide stability, predictable income, and protection against volatility. And if you understand how to position yourself along the yield curve and how to choose between munis, treasuries, and ETFs, you can make them work a lot harder for you. So, grab your coffee, sit back, and let's break this down step by step. What is the yield curve and why should you care? Let's start with the yield curve. If you've seen that squiggly line on finance websites that plots bond yields against their maturities, that's the yield curve. It's deceptively simple but hugely powerful. In a normal yield curve, longer-term bonds pay higher yields than shorter ones. That makes sense. You're locking up money for longer, so you're rewarded more. A typical example would be a 2-year treasury yielding 3% and a 10-year treasury yielding 4%. But sometimes things flip. You get a flat yield curve, where short-term and long-term bonds pay about the same. That signals uncertainty. And then there's the famous inverted yield curve. Short-term yields actually exceed long-term ones. Historically, that's been one of the most reliable indicators of an upcoming recession. Why does this matter to you? Because the shape of the yield curve directly influences how you should invest in bonds. If the curve is steep, you might want to lock in longer maturities for higher income. If it's inverted, sticking short-term until things normalize could protect you. Yield curve strategies you can actually use now. I want to highlight 3 strategies that even everyday investors can use. The barbell strategy, this is where you split your portfolio between short-term and long-term bonds, skipping the middle. Short-term bonds give you flexibility and liquidity. Long-term bonds lock in yields and provide stability. The bullet strategy here, you concentrate maturities around a specific point in the future. Perfect if you know exactly when you'll need cash. For example, paying for a child's college tuition in 8 years. The latter strategy, probably my favorite for income investors. You spread maturities evenly, say every year for the next 10 years. As one bond matures, you roll it into a new long-term bond. Over time, your ladder keeps climbing. These strategies help you manage interest rate risk without having to predict the future, which is something nobody can do consistently. Municipal bonds versus treasuries. The big debate, okay. Let's move on to the munis versus treasuries debate. This is where things get really interesting because while both are bonds, they play very different roles. U.S. Treasuries. Treasuries are backed by the full faith and credit of the U.S. government. That makes them essentially risk-free in terms of default. They're also the most liquid bond market in the world. You can buy or sell them easily at any time. Treasuries are exempt from state and local taxes, but not federal. And while they're safe, the yields can sometimes be modest, especially in low interest rate environments. Municipal bonds, or munis. Munis are issued by state and local governments to fund projects like schools, highways, or hospitals. The big selling point? The tax benefits. Interest is usually exempt from federal taxes, and if you live in the issuing state, it may also be exempt from state and local taxes. But they're not risk-free. Remember Detroit and Puerto Rico. Defaults do happen, though they're rare. They're also less liquid than treasuries, so you might have to sell at a discount if you need out quickly. Here's a quick comparison. Imagine a 10-year treasury yielding 4% and a muni yielding 3%. If you're in the 35% tax bracket, the muni's tax equivalent yield is about 4.6%. That makes it the better deal after taxes, even though the headline number looks lower. How to invest in municipal bonds now? Let's talk practical steps on how to invest in municipal bonds. Option 1, individual bonds. You can buy them directly through a broker. This gives you certainty. You know exactly what interest you'll get and when you'll get your principal back. The downside is that you need significant capital to diversify. Option 2, funds and ETFs. These give you instant diversification across dozens or even hundreds of bonds. You don't get a fixed maturity date, but you reduce the risk of being stuck with just one issuer. Option 3, maturity targeted ETFs. This is the hybrid approach. Companies like iShares and Invesco offer ETFs that hold only bonds maturing in a specific year. These products allow you to build bond ladders with the ease of ETFs. The key thing, always compare the tax equivalent yield before deciding between munis and treasuries. The bond ladder strategy for income now. Let's spend some time on the bond ladder strategy for income. Here's how it works. Suppose you've got $50,000 to invest. You buy 5 bonds. One matures in 1 year, one in 2, one in 3, one in 4, and one in 5 years. Each year, one bond matures. You take the proceeds and reinvest them in a new 5-year bond. What happens? You get steady annual cash flow, and over time, your ladder keeps rolling forward. The advantages are huge. Predictable income, perfect for retirees. Protection against rate swings. If rates go up, you reinvest at higher yields. If they go down, you've already locked in longer maturities. Liquidity. A maturing bond every year gives you flexibility. Bond ladders can be built with treasuries, munis, or corporates. And with ETFs that mimic ladders, you don't have to manage the individual securities yourself. The role of bond ETFs. Speaking of ETFs, let's dig deeper. Bond ETFs have transformed fixed income investing. Instead of needing $100,000 to build a ladder, you can buy diversified exposure with just a few $100s. Benefits include diversification, hundreds of bonds in one ticker. Liquidity, you can buy and sell like stocks during market hours. Targeting, ETFs let you focus on short-term treasuries, long-term corporates, or even tax-exempt munis. For example, iShares 7 to 10-year Treasury ETF, IEF. Vanguard Tax-Exempt Bond ETF, VTB. iShares Investment Grade Corporate Bond ETF, LQD. And don't forget iShares iBonds or Invesco Bullet Shares for laddering without the complexity. Case study. Choosing between munis and treasuries, let me walk you through a case study. Investor A is in a high tax bracket. They buy munis yielding 3%. After calculating the tax equivalent yield, they're actually earning about 4.6% on an after-tax basis. Investor B is in a lower tax bracket. They buy treasuries yielding 4%. After taxes, they still keep close to 3.2%. For Investor A, munis win. For Investor B, treasuries are the smarter choice. This example shows how critical your tax situation is when choosing bonds. Bringing it all together. So where does this leave us? If you prioritize safety, stick with treasuries. If you're looking for tax efficiency, especially at higher income levels, munis are powerful. If you want simplicity and diversification, bond ETFs are your friend. And if you need steady, reliable income, a bond ladder strategy is tough to beat. Add yield curve strategies on top of this, and you can fine-tune your portfolio to match both your goals and the economic environment. Call to action before we wrap up, I want to leave you with 2 powerful resources. If you're looking for a world-class, cutting-edge, user-friendly trading platform app, check out crystalballmarkets.com. It's designed to give traders and investors the professional-grade tools they need without the complexity. And if you want to keep learning through beginner-friendly trading, investing, macro, and financial markets podcasts, head over to Crystal Ball Markets on RSS. It's one of the best ways to stay informed and confident in today's markets. All right, that's it for today's episode of Financial Market Insights for Traders. Bonds may not always grab headlines like stocks or crypto, but they're the foundation of long-term financial security. By mastering the differences between munis and treasuries, understanding yield curve strategies, and applying tools like ETFs and bond ladders, you can build a portfolio that works hard for you in any market. Thanks for listening. I'm Sophia, and I'll catch you next time.